If you are a senior in the United States and you regularly send money to your children, grandchildren, siblings, friends, or other family members, there is an important IRS rule you need to understand in 2026. You may have heard claims that the IRS is now taxing ordinary transfers between friends and family, and that simply sending money from your bank account to another person could suddenly create a tax bill. But the real story is more complicated. And that is exactly why seniors need to pay attention. The IRS has not created a rule saying that every time you send $500, $2,000, or even $10,000 to a family member, you automatically owe income tax on that transfer. In fact, many personal gifts are not treated as taxable income to the person receiving them. But there are situations where a transfer can create reporting requirements, gift tax consequences, or in 2026, a completely separate issue involving certain international remittance transfers. And if you are retired, living on Social Security, a pension, IRA withdrawals, or other fixed income, the last thing you want is to misunderstand a rule and discover a problem later. So today, we are going to break this down in simple terms, because the biggest mistake seniors can make is assuming that every transfer is treated exactly the same way. Let's start with the rule that gets the most attention. For 2026, the federal annual gift tax exclusion is $19,000 per recipient. That means a donor can generally give up to $19,000 to one person during the year without that amount being counted against the donor's lifetime gift and estate tax exclusion, assuming the gift qualifies for the annual exclusion. And this is where many people misunderstand the rule. The $19,000 figure does not mean that if you give your daughter $20,000, the IRS automatically sends you a tax bill for $20,000. That is not how the federal gift tax system works. If you give more than the annual exclusion to one recipient, you may have a gift tax reporting requirement, generally using Form 709, and the excess can reduce your available lifetime exclusion. So imagine you are a retired parent and you want to help your adult child with a $25,000 emergency expense. You transfer $25,000 to your child's bank account. The first thing you should understand is that this does not automatically mean your child owes income tax on that $25,000 simply because the money came from you. Instead, the transfer may be treated as a gift. And because the amount is above the $19,000 annual exclusion for 2026, you may have a gift tax filing issue to consider. The distinction is extremely important. A reporting requirement is not the same thing as an immediate tax bill. This is one of the biggest points seniors should remember. Another situation that can create confusion is when parents regularly send money to adult children. Maybe you pay your daughter's rent. Maybe you help your son make a mortgage payment. Maybe you send your grandchildren money for college expenses. Maybe you give a family member $1,000 every month because they are struggling financially. The fact that the money is transferred electronically does not automatically make it taxable income. But you should still understand what the payment actually represents. Is it a gift? Is it repayment of a loan? Is it payment for services? Is it reimbursement for an expense? Those distinctions matter. If you are actually paying someone for work they performed, that is a very different situation from giving a family member a personal gift. And if you loan money to a relative with an agreement that they will repay you, you should not casually label it a gift just because the transfer went from your checking account to theirs. Documentation can become extremely valuable when large amounts of money are involved. Now, let's talk about something new in 2026 that deserves special attention, especially if you are a senior who sends money to family members outside the United States. Beginning January 1, 2026, a new 1% excise tax applies to certain remittance transfers sent from the United States to recipients in foreign countries when the sender provides cash, a money order, a cashier's check, or another similar physical instrument to the remittance transfer provider. The IRS says remittance transfer providers are responsible for collecting the tax in applicable transactions. This is very important because it is not the same thing as the federal gift tax. These are two different rules. One involves gifts and potential gift tax reporting. The other is a new excise tax on certain remittance transfers. So, if you are a senior sending money to relatives overseas, do not assume that every international transfer will be treated exactly the same way. The payment method and circumstances matter. The IRS specifically describes the 1% remittance tax in connection with certain physical payment instruments. And this brings us to one of the most important mistakes I want seniors to avoid. Do not hear the words IRS, money transfer, and 1% tax, and assume that every Zelle payment, bank transfer, electronic family payment, or domestic gift is automatically subject to this new remittance tax. The IRS guidance is much narrower than that. The 1% excise tax applies to certain remittance transfers and is tied to the way the sender pays the remittance transfer provider. So if your son lives across town and you transfer $2,000 from your checking account to his bank account to help with his car repair, that is not automatically the new 1% international remittance tax. If your daughter lives overseas, however, you need to look much more carefully at how the transfer is being made and whether the transaction falls under the new remittance rules. This is why seniors should never rely on a social media post that simply says, "The IRS is taxing family transfers now." That statement is far too broad. The better question is, what kind of transfer are you making? Who is receiving it? Why are you sending it? Where is the recipient located? How are you paying? And what documentation do you have? Now, let's talk about another issue that can surprise retirees: large transfers. Suppose you sell an investment property and decide to give $100,000 to your son. Or perhaps you withdraw money from an investment account and transfer $50,000 to your daughter to help her buy a home. That is very different from giving someone $200 for groceries. When the amounts become large, you need to understand the gift tax rules and possible reporting requirements. The IRS explains that the federal gift tax applies to transfers of money, property, or other assets, and Form 709 is used to report transfers that are subject to federal gift and certain generation-skipping transfer taxes. And there is another reason seniors should take large gifts seriously: estate planning. Many retirees spend decades building savings, investments, a home, and retirement accounts. When they begin transferring significant amounts of wealth to children or grandchildren, those transfers can become part of a much bigger estate planning picture. In 2026, the IRS says the basic exclusion amount for estate and gift tax purposes is $15 million under the current law. That is a very large amount, which means most ordinary families will never actually pay federal gift or estate tax simply because they help their children financially. But that does not mean reporting rules can be ignored. Now, let's look at an example that could apply to many seniors. Imagine a grandmother gives $10,000 to her granddaughter in 2026 to help with tuition, living expenses, or another personal need. That amount is below the $19,000 annual exclusion for gifts to that recipient. Generally, that gift falls within the annual exclusion. Now, imagine the grandmother gives the same granddaughter $30,000. That does not automatically mean the grandmother owes federal gift tax on $30,000. But because the amount exceeds the $19,000 annual exclusion, she may have a gift tax reporting obligation and should understand how the excess affects her lifetime exclusion. This is why simply saying anything over $19,000 is taxed is also incorrect. The $19,000 figure is an annual exclusion amount, not a universal tax threshold that automatically produces a tax bill. And seniors should also remember that gifts are generally not the same as earned income. If you receive $5,000 from your mother as a personal gift, that does not automatically mean you should treat the $5,000 as wages or ordinary income on your federal tax return. The tax treatment depends on what the payment actually represents. On the other hand, if your parent sends you $5,000 because you performed services for their business, that is a completely different situation. The label matters, but the underlying facts matter even more. Now, here is another common situation: family members sharing expenses. Suppose you and your sister jointly pay a $4,000 medical bill for your mother, and she reimburses you for her share. That is not necessarily the same as making a personal gift. Or suppose your adult child temporarily sends you $2,000 because you paid their property tax bill and they are simply reimbursing you. Again, the reason for the transfer matters. This is why seniors should keep basic records for unusual or large transfers. You do not need to turn every family dinner into an accounting exercise. But if you are moving tens of thousands of dollars, write down what the money was for. Keep the transfer confirmation. Keep the loan agreement if it is a loan. Keep receipts if it is reimbursement. And if it is a significant gift, consider getting professional tax advice before moving the money. Now, let's return to international transfers, because this is where 2026 introduces something genuinely new. If you send money abroad using certain physical payment methods, the new 1% remittance tax may apply. The IRS has issued guidance and proposed regulations explaining how the new remittance transfer tax works, and the agency says providers have collection and reporting responsibilities. For example, if an eligible remittance transfer is $2,000 and the 1% excise tax applies, that could mean $20 in tax. A $5,000 applicable transfer could mean $50. The exact treatment depends on whether the transaction meets the legal definition and the payment method used. This is why seniors sending money overseas should ask the transfer provider a very specific question. Does this transaction fall under the 2026 remittance transfer excise tax, and who is responsible for collecting it? Do not guess. And do not assume the tax is the same as gift tax. They are separate rules. There is also an important practical lesson here for seniors who receive suspicious phone calls claiming to be from the IRS. Scammers can take real tax rules and twist them into frightening demands. Someone might tell you that your bank transfer has been flagged, that your child owes an IRS transfer tax, or that you must immediately buy gift cards or send cryptocurrency to release a family payment. That is a huge warning sign. Real tax rules should not be used as an excuse for someone to demand payment through gift cards, cryptocurrency, or unusual methods. If someone contacts you unexpectedly and claims your family transfer has created an urgent IRS problem, stop and verify the claim independently before sending money. Now let's summarize the 4 things seniors should remember in 2026. First, ordinary family transfers are not automatically taxable just because money moves from one person's bank account to another. Second, the 2026 annual gift tax exclusion is $19,000 per recipient, and going above that amount can create a gift tax reporting issue without necessarily creating an immediate tax bill. Third, there is a new 1% excise tax on certain international remittance transfers when the sender pays using specified physical instruments, and this is separate from gift tax. And fourth, the bigger the transfer, the more important documentation and professional advice become. If you are a senior helping your children, grandchildren, siblings, or friends financially, you do not need to be afraid of every bank transfer. You simply need to know what type of transaction you are making. Before sending a large amount, ask yourself, is this a gift, a loan, a reimbursement, payment for services, or something else? Is the recipient in the United States or another country? If it is international, how am I sending the money? And if the amount is significant, do I have records showing why the transfer was made? Those few questions can prevent a lot of confusion later. The IRS is not suddenly taxing every dollar that grandparents send to their children. But 2026 does include important rules that seniors should understand. especially when gifts become large or when money is sent internationally. So don't panic, but don't ignore the rules either. If you regularly help family members financially, take a few minutes to review your transfers and keep proper records. And if you are planning a very large gift, speak with a qualified tax professional before making the transfer. A few minutes of planning can be far less expensive than trying to fix a tax or reporting problem later. And if this information helped you, share this video with a senior parent, grandparent, friend, or family member who regularly sends money to relatives. They may not have a tax problem at all, but knowing the rules before moving the money can make a very big difference.